Hello, friends. Testing, mic check. You know what to do. If you can hear me, let me know in the chat. We'll fire up the intros and we'll get started. Excited to be here. Just always like to make sure the audio is good before we kick it off, since we have had our problems in the past. Hello, everyone. All good? Let's do this. Hello. Welcome, my friends, to Alpha Beta Soup. I'm TXMC, and we are live. It's November 2nd, 2023. It's 11 a.m. here in the middle of the United States of America. Hope you're all having a great day. There's been green candles on the price charts. That's weird, right? I don't know what to do with my hands, guys. I'm a little uncomfortable here. We've had green candles. Numbers go up. What is this? This is weird. I'm very unaccustomed to this. Not really sure how I should be acting. I don't know if I'm supposed to call my mother in this situation, or I don't know. But I'm just going to watch it and hope that I don't disturb the uptrend in its natural habitat. All right, we just observe and report. We do not disturb it. Oh man, it's good to see numbers going up, isn't it? It's good to see that. Don't know how long it'll last, but we must enjoy it and embrace it while it is here. Don't fight the uptrend. Don't fight the green candles, right? You know, we talk a lot about economic risks on this channel. We have modeled out extensively the risks to recession, and all of those things are still valid. But seeing a bunch of storm clouds brewing on the horizon and not really being sure how far away they are doesn't preclude us from enjoying an uptrend over the next few weeks or the next month or two or however long it lasts. And we can still anticipate the likelihood of a recession at some point, though it gets difficult to try to see how that plays out when things are going fairly well, all things considered. There's a lot of problems in the economy. There's more so in the global economy than in the U.S. specifically. And there's plenty of things to be worried about, hesitant about, etc. But Bitcoin's going up, crypto's following it, equities caught a strong bounce this week. We'll talk about all that stuff. But I think it's just important to understand the differences in time frames. When we look at recession modeling as a group here, the time frame for that to play out has always been, and those of you who have followed me for the entirety of this year know this, the time frame has always been into 2024. Right? It's always been into like May, April time frame of 2024 is when we have examples of recessions. That doesn't even mean it has to happen before then. That's just when we have examples of it happening. And the hardest part about being a macro analyst is that there is no rule book. There is no rule book. There's no science. There's just a bunch of historical tendencies and probabilities of things happening and sequences that are reliable. But there's no guarantee. There's no surefire, this always causes a recession. And so that makes it really difficult in real time to balance the narratives that are coming out of the market, the actual price action, and then the slow drip of economic data month after month, quarter after quarter. Trying to marry all that together can be a challenge. But for the time being, everything is going up, and that is wonderful. And the really interesting thing about the crypto rally is that it hasn't just been Bitcoin. I've seen some of my friends, my Bitcoiner friends, saying things like that, capital is flowing into Bitcoin, that alts are, quote, withering. I actually saw that word withering from a person I respect quite a bit. And those are just blatantly false. This has been a fairly, broad rally. Now, it's not all of crypto. There's definitely some coins that have hung back. Ethereum is still below its year-to-date highs. Like relative to itself, it's still down here somewhere. You can see that. See, it's still below its highs. Not everything has taken off, but a fair chunk of the market has. And when you look at the altcoin market minus stable coins, you can see it has been going up, right? Just in the last couple of weeks, since the middle of October, the altcoin market cap is up $54 billion, 27%. That's not nothing, right? That's not capital only flowing into Bitcoin. That is a more broad-based rally. And if I'm just looking at crypto, I don't talk about altcoins a whole lot on this channel, but it's part of the market, right? And I think if you're looking for a dynamic that's going on in crypto, there's coins that follow Bitcoin, right? There's coins that follow more Ethereum, then there's some that kind of do their own thing. Those that are more sympathetic to Bitcoin, they benefited from this move. And then BTC has ripped up and it's just been kind of holding these levels. Really, if we zoom out, what is this level? Well, it's about halfway from the previous resistance up to the next level of resistance. I can kind of draw, this is not a perfect science here, but we can kind of draw like a little range, right? From the prior resistance up to the next set of resistances. And that's basically where it stopped out at, the midway point. It's just kind of hanging out here. And, if you would have expected that if this was going to be just some, boring Bart Simpson like we get all the time, like one of these right here where it rips sideways and then falls, you maybe would have thought it would have already happened and that we would already be back down below these highs here at 31 and change, but we're not. Maybe we still go there. There is no way to know. But this kind of grind up and then slow accumulation, higher lows, higher highs, that's a good uptrend, right? That's a quality uptrend. And it's also the kind that can induce FOMO because it doesn't give people the pixel perfect pullback down to prior resistance that they're hoping for. And that happens a lot in Bitcoin uptrends, right? Like when it goes, it just fucking goes. And it just doesn't give you a chance to get on if you wanted to be part of that move. And so you have to wait or you have to FOMO in. And I think that when you look at how long we talked about this in the last stream last week, if you look at how much time we spent under this level here, and now we're well above it, there's going to be a lot of people, including myself, just logically, I have said, it makes sense that we would see price come back down and want to test this 31 level. That makes sense from a price structure perspective. But that's not necessarily the easiest path, right? Like that is the easiest path. That's not necessarily the most desirable path for the market. It tends to go in the most painful direction, right? Because that tends to be the place that garners the most liquidity. And if we just got some pixel perfect little pullback right here, that wouldn't really satisfy all that criteria. I actually think it's probably, there's a decent chance that it just doesn't go back down and visit this level until it's done with this current directional move, however high this goes. How high that is, I'm not sure. Let's put some fib retraces on here. This is something we talked about some last year as well. Talked about how Bitcoin hadn't really gotten a big full retrace at any point during this bear market, and it often has those. You go back all the way back to like 2013, and every fall from the peak had a sharp move back higher into the 618, 702, 786 retracement area, right? All of them had a bounce back up into this general area here, right? I'll show you on the 2017 cycle, just as one example. Here's the all-time high, right? We set this. We had this sharp move down. What is this? This was like a 50% drop. And then we bounced all the way back up to the 702, and then that was lights out. And we have these moves. These moves happen on equities all the time. This happened at the end of the first part of the bull run in 2020. The same kind of move, right? Up here. Some of you who watch Blockchain Backer, you might have seen some of this stuff. He and I look at similar tools. Look at that right there. Perfect retrace and then lights out. But the thing is, we didn't really get one of those over here for Bitcoin in this end of the bear market, this side of the market. We never really got one of those. The closest that we got was here in early 2022 as we were rallying back up before Luna collapsed, and we got to about a 40% retrace. That's the highest we've gotten during this entire bear market. And it's pretty unorthodox for that to be the case, for us to just bleed straight down, and then the new bull cycle starts and we just go straight back up. That's just a little uncommon. Doesn't mean that we have to have a retrace, but it is atypical not to have one. So maybe we're starting to print that now. Maybe we're actually going to get up into these levels here. That seems far away. And before we do that, we've got a lot of supply right here to work through. A lot of churn and chop between 38 and call it 45,000. It's a lot of work that I would assume would need to be done before we can really start looking at these levels up here. I don't know if we'll get up to the 618, which is currently at 48,600. But as we looked at, we're kind of in the midway point, right? From the prior resistance to the next resistance. If we draw out this, I'll draw it one more time. Kind of right in this area. This isn't pixel perfect, but you kind of get the idea. So the next area up is like the 38s. And what I think we could watch for, the longer that Bitcoin stays up here without pulling all the way back, the more I think it will entice other parts of the crypto market to start trying to play catch up. Last night we saw ETH wake up a little bit after a huge move from Solana. Look at Solana the last few days. Just absolutely nuclear rally. 100% rally since the middle of October. And if you look at this compared to Ethereum, it's incredibly imbalanced, right? And it's almost ripe for a rotational move. It's up 80% against Ethereum because Ethereum was kind of hanging back. And these two are watched closely. Sol F is a pair that a lot of people keep an eye on. I think now that we've seen this big move from Solana, we've seen it break well above the consolidation of the year, and now we're up into its kind of retracement areas. It's really low, but maybe it starts climbing a little higher. But I think that because it ripped so high and now it's up into this resistance, that we might see a rotation into ETH, you know? And last night we started to see Ethereum wake up a little bit. You see that? It started to wake up, started to break higher. It had been consolidating here, and it started to break higher. It set a new high, but then is now pulled back. And it's still, like I said, it's still behind. It's not above its year-to-date highs. But because of the big move from Solana, because Bitcoin's been holding its gains, it seems like just a matter of time before Ethereum starts to catch up. And really, you know, relative to Bitcoin, it's near its lows, right? It's near like range lows on ETH BTC. Let me see if I can put this up here like this. Yeah, we'll do this. Look at that. See, it's kind of been in this little choppy range here for like 2 years, and we're basically at those lows. So if we can see ETH BTC get back up here like that, after we just saw that massive move from Sol ETH here, it just seems like there's an imbalance in the favor of Ethereum. And that could set up, where's FBTC, sorry, and that could set up for Ethereum to play a little bit of catch up, maybe, if this rally actually continues. But that's crypto, right? And who really knows where it's going to go? It has decoupled a bit from equities. It started to lead a bit, but in the last few days, the TradFi market has also been ripping. I mean, look at these candles, right? This is yesterday, the S&P was up 1.3%. Today, it's up 1.3%. These are big candles for the S&P. That move on the S&P came right after a sweep of this level. Right, we had this prior resistance. We broke above it. We came back down and tested it. We've now swept it. And on the reclaim, we've had two really strong candles. Part of this is because of some of the news that we got about how the Treasury is going to be issuing debt. So it's important to understand that because the US is running massive deficits, suddenly everyone in TradFi has become an expert on Treasury refunding announcements. And so every couple of months, every like 3 months, the Treasury will put out an estimate of how much money it's going to borrow in the next 2 quarters. So when we got that announcement back in May for the July to September quarter, it had a certain number on it. It was about 700 billion, I think. Let's look at it together. Let me pull it over here. Yeah, okay. Make this a little bigger so you can see it. So you can see May 1st, 2023, the U.S. Treasury announces marketable borrowing. This is their regular output. They put these out all the time. On May 1st, they said during the July to September quarter, Treasury expects to borrow $733 billion. Now, that's a big number, but that's the number, right? That's what they expected. And so the market, that was May 1st. That was where's May? Back in this area right here. We were consolidating under this resistance. We got this move higher, right? This was led by various things, AI hype, all kinds of shit. But fast forward to July. Fast forward to the next one of these. It was at the end of July. It was on July 31st. Now, remember, during the July to September quarter, the Treasury expects to borrow $733 billion. That was in May. Fast forward to July. During the same quarter, the Treasury expects to borrow $1.007 trillion. So it jumped from $733 billion to $1 trillion. This borrowing estimate is $274 billion higher than announced in May due to lower beginning of quarter cash balances, lower receipts, and higher outlays. Outlays is government spending. So because of a bunch of factors, the number they thought they were going to borrow went up by 25%. Or, I mean, actually, it's more than that relative to 750. It's more like 30%. So it shot up dramatically. And this day, right here, was right here. It was right here. You see this gap? That was that news right there. This is, and then we had a red day, and then we gapped down the next day because on July 31st they gave the announcement, and then on August 1st, the very next day, they put out the distribution of the different debt instruments that they're going to release. We're not going to look at that table, but right after this announcement, the next day, they put out this big table, and it says we're going to issue this many 1-week bills, 4-week bills, whatever, right? 2-year notes. They list the whole table, and in that table, it showed a larger amount of long duration, meaning like 10-year, 30-year. And that was necessary to fill in some of this gap here. And the market started to anticipate more duration hitting the market. So what did we see? We saw long-dated yields begin to rise. We had our bear steepener, right? That was the same period of time, and equities began to fall. So that was right around here. Look at the end of July. See, here's the end of July. And what happened? Yields began ripping from there, and equities began to fall. That was really what put in the top for this rally, was Janet Yellen saying, oops, we estimated 750 billion and now it's $1 trillion. Well, that brought us all the way down here. And then we just got another one of those this week. And during this whole process, the narrative around this topic was the deficits are exploding because rates are so high, and because they will stay higher for longer, the deficits are just going to continue to get higher and bigger and larger, math. And because of that, they're going to have to issue more and more duration. They can't just issue, 3-month bills to fund the entire US government forever. And so with that anticipation, it started to create a bear steepener in the market in anticipation of that supply. Bonds sold off, yields went higher, equities fell, and we came into the announcement this week, which was expected to be a similar thing, right? More duration hitting the market. So let's go back to these announcements. Here in July, they said for October to December, they were going to borrow $850 billion. That's a lot. That's more than they originally projected for the quarter before they had to raise it. $850 billion. Well, fast forward to this week. That number changed to $776 billion. It was $852. It changed to $776. This borrowing estimate is $76 billion lower than the one announced in July, largely due to projections of higher receipts, somewhat offset by higher outlays. So they anticipated slightly less borrowing necessary. Now, that is still a massive number historically. That is important context to take away. These are really fucking big numbers. But it's less than what the market anticipated. And everything in the market comes down to reality versus expectations. It isn't always the absolute level that matters. What matters the most is what did the market think was going to happen, and then what actually happened. That's the difference between those two things is what drives prices in either direction. So the market was surprised by less issuance. And then we got the distribution of those things yesterday in a table that, again, we're not going to look through because I'm not an expert at that. And I don't want to drag you through the mud looking at a bunch of data. But the amount of duration, the amount of 10 years, 30 years, long dated debt instruments, that was a lower number than the market expected. So not only was the borrowing less, but the amount of duration was a bit less of an increase than the market assumed would need to be there. So you combine all that stuff with the Federal Reserve yesterday pausing for the second straight meeting and keeping the Fed funds at 5.5%. All that combined together, you get a nuclear pop in equities off of a sweep of prior support, resistance turn support. So that's how we get one of these big pops. That's how we get 2 straight gap up days on the S&P. It's 2 straight gap up days. And I think that this sets up to be supportive of this continuing to climb for the next few days. Now, it's moved really fast, so it might come into resistance more quickly than I would have thought. But just thinking seasonally, how the end of the year does tend to have more positive flows, just generally for risk assets. And then the market was anticipating this bear steepener continuing for the next couple of months and fully uninverting all of the yield curves because the Treasury is going to issue massive amounts of duration and just dump, long duration supply on the market. Since those expectations got tamped down a bit, and because now the market anticipates there is a higher probability that the Fed is going to pause, or that they're done, rather. That's what I meant to say. There's a higher probability in the market's opinion that the Fed is done raising interest rates completely for this cycle. We don't know, but they are assuming so. 2 pauses in a row is highly indicative of that being likely. Then the market is pushing higher, at least in the near term, right? Now, I was asked today if this changes any of my opinions about recession or what the next 6 to 9 to 12 months could look like, and it doesn't. It doesn't change any of that. But I just come back to what I opened this stream with, talking about how difficult it is just modeling these situations. Right? We're in a macro cycle of untold complexity. There are so many different plates spinning all at once. We just came out of a massive global economic shock in COVID that changed the world we live in. It fundamentally changed multiple aspects of economics, of finance, of the way we live our lives. We're still dealing with those consequences. They're still rippling through society, through all of the charts, everything, right? And it makes this an indescribably difficult cycle to try to compare to prior eras. And that's just the nature of it. It's going to be that way. It will probably not ever be crystal clear for us, even if we get to some place where some black swan happens and we feel like we're having our Lehman moment. Even then, what's happening ahead of us will still be uncertain. It will be even more uncertain. And so knowing all of that, my forecast doesn't change at all. But the market wants to go up. It needs reasons not to go up. And it just had a couple of those reasons taken away. So it's going to go higher. Now, will it set a higher high? I don't know about that. We've got some work to do here. But if we just look at this leg of the market and we're talking about retracement levels, which is something we talk about all the time, maybe it gets up into here. Maybe it gets up into 4450 or, 4,500 even. before it rolls back over. And it could do that over the next month, right? It doesn't have to go there in one straight line just because the last 3 days are really strong. You don't just extrapolate this rate of change and just say, well, we're going to be up here in 2 days. Well, maybe not. Maybe we kind of do one of these. And then by the time we get to mid-December, we're up here. That could happen. All of that could happen with a backdrop of a potential recession just over the horizon. And that's what makes this really challenging. So I explain that because a lot of us are going through this kind of a market for the first time. I was not an investor in 2008, right? I'm going off of what I have learned, what I remember from that era, and what the data tells us about it, right? This is really my first proper big bear market cycle that I believe that we're going to be going through. And so it can be really difficult to estimate how long things take and then to actually experience it. Like, it's one thing to say, well, the recessionary process takes 2 years to play out. It's another to sit there for 2 years and watch data roll in week after week, month after month, and continue to maintain that perspective. That is incredibly challenging. And even me, right? Like, I have been on this channel with you guys ever since the yield curve inverted at the end of last year. I've been on Twitter. I know I wasn't making videos the whole time, but I've been presenting content that says recessions are coming, most likely, or a recession is most likely coming, but it's probably a year away, right? It could be as much as a year and a half away. I was saying that at the end of last year, in like October, November, December of last year. And even knowing that we didn't have an example of a recession for another 7 or 8 months, which is right here, 1973, 74, that period, that 7 months was May of 2023 relative, excuse me, I have the hiccups. Relative to when the yield curve inverted in October of last year, 7 months later is May of this year. That wait from October to May was agony. I didn't know what was going to happen. We had a bank failure right in the middle of it, and I thought, well, that's the trigger event, surely. Well, then the Fed came out with a facility, backstopped the losses of the regional banks, and the market turned around and ripped higher through the summer on AI news. Meanwhile, these data points continued to decline. Job growth continued to decline. A whole bunch of other metrics continued to decline. The examples of recessions continue to lay out in front of us. There are still examples of 4 other recessions ahead of where we are today relative to the yield curve being inverted. So even knowing all that stuff, even me knowing that, I can recite this for you with my eyes closed. But that doesn't make it any easier for me to sit through this cycle and to try to come on these streams with you and have a level head and have some kind of modicum of sense out of all this. It's difficult. And if it's hard for me, then I know it's hard for other people who aren't even doing their modeling in this way, right? Who don't even fully understand the amount of time it actually takes from the beginning of a Fed tightening cycle to the economy slowing down. Most people have not done this kind of work like we've done on this channel together, really understanding the sequencing and the timing of these things and the rate of change that drifts us towards an economic slowdown. Most people don't even grok that, right? They just think, well, yield curve inverted, that leads to a recession, and that's about as far as they go with it. Maybe they have 1 or 2 other data points. But we can see it slowly playing out. But there's been a lot of fake outs, right? Even right now, if we go look at the cyclical parts of the economy, some of them are starting to tick up, right? Like if we look at real retail sales relative to the yield curve inverting, for much of this cycle, it's been below the average, right? The black line being right now and the gray line being the average of all the prior eras. For most of this time, real retail sales has been pretty low. It's been one of the worst performers of any prior era. But just in the last few months, we've seen this value start to tick higher. And in a way, it kind of resembles 1966, which is something we've talked about on here quite a bit, right? We're watching to see if we're going to look like 1966. Well, this is what 1966 looked like. It was this purple line right here. And here we are in the black, with the gray being the average of everything else. And you can see real retail sales in 1966 dipped really hard, and then it began to recover. We're doing something similar. We didn't go down as deeply. We have our own fractal, but the behavior is similar, right? But then you go look at something else. You go look at like job growth over here, non-farm payroll growth, and we're still just drifting down in accordance with the long-term series average. Now, we do have a slight uptick in job growth right here, just from month to month, from September to October. And it's happening right at the apex point, right? We talked about this as a group right here. This is the moment when in 1966, the economy began to reaccelerate. It was about a year after the yield curve had inverted, and things started to pick back up again. They did have a recession about a year and a half, 19, 20 months later, I believe, but they avoided it for the time being. And we've been wondering, will we do that? There is still a chance that we do that. There's no guarantee of recession. We talk about it a lot because it's the biggest risk, and we need to measure the risks. But it doesn't mean it's for sure going to happen. And we're in that moment where maybe the data starts to pick up. But again, that's one print on the non-farm payrolls, a single print. And if you look at what the manufacturing PMIs have done recently, they are showing you why you shouldn't get too excited about a single print on the economic calendar, right? I'll show you here in a second. Let me throw up date, month. Let me find manufacturing PMIs. Here we go. Let's put a filter on here. Range of dates. Let's just pull it sometime near so we can see. Okay. So over here, let me zoom in even more. Zoom in even more. Let's make this bigger. Sorry, you guys are watching me build the chart for you in real time here. All right. This is the manufacturing PMI. Let's put a line on 50 just so we can see it. Okay. This line in the middle is the middle point of the PMIs. So for the last few months, it has been really negative. We've done a lot of research around the PMI being at this level. We've recognized, and you can find this in the Recession Roundup series on my channel. If you go to the channel on YouTube here, and you go to playlists, and you go to Recession Roundup, it's in here. I don't remember which video. It's one of the first couple, I believe, maybe the second or third one. We talked about the likelihood of recessions when the PMI is below 47 and how many of them began with the PMIs below 47. And so we spent some time down here and we watched this closely. But then over like a 2-3 month period, the PMIs picked back up and they bounced all the way back up to 49, meaning that almost a 50-50 split of businesses were on average reporting positive sentiment about the coming quarters, right? It's a survey of business conditions. Well, yesterday we had a massive tick down on the manufacturing PMIs. A big setback. And it was kind of across the board. You know, the PMI survey has a bunch of different data points on it, and they all pulled back a bit. And that happened after 2 or 3 months of steadily climbing, and it just kind of gave it all back. So it's important not to get carried away by 1 or 2 or even 3 months in a row of a print. You have to make sure that you are observing the true trend. And when you're in an era of untold complexity, as we are right now, it is important not to get carried away by 1 or 2 or 3 prints and to ensure that you are observing the trend. Wait for the trend to tell you the story. There's no reason to try to catch the pico bottom of the knife drop, right? Not in an environment like we're in right now, where volatility across assets is much higher than normal. What else was I going to look at? So that's kind of where we are with the economy. We can see that the job growth situation, we've talked about how labor growth, the rate of change of jobs being added to the economy, has slowed down quite a bit. It has found an equilibrium of sorts, near the average from between the great financial crisis and COVID. We're right back in that wheelhouse. But we've also seen a slight acceleration. This is that tick up in job growth right here that we saw over on the other table that compares it to 1966. This one right here. You see this slight uptick in the black line. That's the same slight uptick that we see right here. This is the same data point. But we're hanging on to right inside that average. If we look at some of the other pieces inside of labor, here, like the amount of people listed as unemployed, that is continuing to rise commensurate with prior recessions and is slightly above the average growth rate. The number of people listed as unemployed. Temporary workers, that's been another one. It's been showing a lot of weakness. It's still, it's still below its normal growth, or it's still right around its normal growth rates. The labor market generally has been kind of following the script. The question now, as we've discussed at length on here, is whether or not jobs will be able to hold up because the credit edifice has been completely choked off, right? As we've explored together. And I showed you last time, I showed you this chart. Excuse me. I showed you this chart and I showed you how the growth of credit across business loans, consumer loans, real estate loans, and all bank loans were below the majority of prior recessionary eras. And so if we see that, we then need to look at the other piece of consumption, the other fuel for consumption, which is people's incomes, and that is their employment. So that's why we're focusing so much on job growth. And that's why I think it's really the only data point to watch at this point. The leading economy, the cyclical economy, real manufacturing and trade sales, real retail sales, industrial production, the manufacturing PMIs, and really everything related to those sectors. Those have been telling a pretty unambiguous story for about a year and a half now. It's just that they got way out ahead of the economy itself, which has been far more resilient than really anyone was anticipating. Here's another kind of look at the different pieces of the current economy and where they rank relative to prior eras, to prior recessions. So if you look at the top, this is yield curve proximity, meaning how many months since the yield curve inverted, 1 month through 11 months. And over here's a bunch of the different data points we look at. Now, these colors are the rank of this era versus 9 or 10 other prior recessions. And what you can see is the red means that this era, this 2022-2023 era, in terms of growth rate, ranks at the lowest of all prior eras. So like I explained about credit, you can see that here. It's manifested here on this view of credit. Bank loans, business loans, real estate loans, and overall credit are all dead last in growth rate versus prior recessions going back to about the middle of last century. This says 1937, but some of these credit points don't start till like 1950. Regardless, about 9 or 10 recessions, credit growth is as bad as it's ever been. But some other things are not as bad. Real manufacturing and trade sales, real retail sales, people's incomes. Those are a little more in the middle of the pack, and they have been improving, right? Like look at real retail sales. About a year ago, around the time that the yield curve inverted and in the few months afterwards, real retail sales was one of the worst we'd ever seen. Well, it's been improving here in the last few months relative to prior recessionary eras. Same thing with people's incomes, right? Real income was about as bad as it has ever been in the 7 or 8 months following the yield curve inverting. So that was from October of last year till about May of this year. But since then, in the last 3 or 4 months, real incomes have improved relative to the comparison, relative to what causes recessions. So we've got a real mixed bag here. We've got high job vacancy rates. We've got pretty good incomes. We have absolutely abysmal credit. And we've got dead center, middle of the road job growth. It's a real mess. There's no clear idea, no clear indication of what would actually stop this economy in its tracks right now. What people are anticipating is that the consumer will slowly lose steam. We haven't yet seen that, right? We know that student loan payments have resumed. We know that personal savings has absolutely plummeted from the levels it was at pre-COVID. We can go look at that real quick. Personal savings rate. You can see that here. That's a little too zoomed in. Look at the last 20 years. You can see personal savings. It ticked up a bit in the first part of the year, but it's come all the way back down. The excesses of COVID in terms of rate, the flow of personal savings have come all the way back down to like their decade lows. And people have been anticipating that the consumer would just simply run out of steam. But they continue to have 4% wage growth and full employment. We just saw job openings tick higher, right? They're not going lower. That they needed to go lower for the Fed to be able to say, yeah, we're actually softening labor conditions. But in the last two prints, it's gone higher. So the job market is incredibly tight. It's in fuego. There may be some people on the sidelines who aren't currently working, and maybe that began because of COVID, but on an aggregate level, at the national level, everyone who wants a job has one. And so we haven't really seen a sustainable uptick in the amount of people that are unemployed. The unemployment level, as we can see over here, that number has been steadily rising, but the labor force has grown and it has offset that a little bit. So when we look at the unemployment rate, it's barely moved. It's right here at 3.8, which is higher than it was for a few months, but is still really low. So a recession remains still a high likelihood because of all of the different components that have fired off certain growth rate signals and drawdown signals. However, we also know that we have an example that didn't lead to a recession, and we still aren't sure if we're printing one of those. So over the next few streams, over the next couple of months, we'll continue to check back in on this chart. And maybe by December or January, we'll have more of an idea of what this is going to do. I don't know, guys, right? Like, I'm just a guy on the internet at my house charting this stuff for you. I'm not an economist. I don't have secret information. All of this is public data. And so I don't really know. I don't know what we're going to get. Maybe we get this over the next couple of months. And then we're like, wow, that's really starting to look like 1966. I'm going to actually start feeling kind of upbeat if that's the case. But we just don't really know yet. And so it warrants continuing to be a little cautious on those things. So let me take a breath here. Let me take a sip of my coffee. And let me scroll through the chat real quick. There's a couple other things I want to touch on before we get to the end of the stream, if we have time. But I want to get to you guys first. We have 130 likes and 187 viewers. So if I can get about 50 of you to smash the like button, we'll be in really good shape. But let me scroll back on the chat here and see what we got going on. Oscar Hernandez with the $5 right out the gates. Thank you, brother. You're an OG. Really appreciate you. What do I think will happen if the reverse repo drains to zero? Will it cause a panic within the Fed? No, it won't cause a panic. So the overnight reverse repo is just a facility. We've talked about this before on the channel. It's just a facility that holds money for money market funds and a few big institutions. There's only so many players in the space that can put money in this pool right here. And it was holding over $2 trillion and paying them, a going rate. If you look up award rate on Fred, it will tell you what the rate is in the overnight reverse repo. And you can see it's been ticking up with interest rates. It's really close to the interest rate. It's 5.3, so it's just slightly below the upper limit of the federal funds rate, and it's slightly below some of the going rates on treasuries, which is part of the reason why we have seen money leaving the reverse repo, because they can get slightly better than 5.3% on certain instruments. So we've seen money coming out of reverse repo. It's come out about 50%. There's still $1 trillion left. Maybe over the next 5 to 6 months, it drains at the same pace. And then by next April, perhaps it's empty again. It was empty for a really long time. It's not normal for it to have trillions of dollars sitting in it, right? Just look at the history here. It was really April 2021, May 2021, March, so, that period of time when it started to go in here. And I don't understand all the mechanics of why. I'll go look into that and try to learn more about that. But regardless, do I think it will cause a panic in the Fed? No, I do not. Because this is not the only source of demand for U.S. debt. There is a gargantuan demand for quote unquote safe collateral, liquid collateral in the system by design. There's so much leverage. There's so much refinancing that has to occur. There is an immense need for collateral. And the Treasury is the collateral instrument of choice for these institutions. So while the reverse repo is a very interesting thing to watch, and it's the most obvious and public marginal source of demand for treasuries, it is not the only source. There are still foreign buyers. There are still many other private buyers of debt, pension funds, other things like that. So it's not just the reverse repo. We have funded the government for many years before without any money at all being in here to come out. So it's just a dynamic to watch. It's something interesting. And the market is watching this a lot because everyone's been paying attention to the reverse repo. So it's on everyone's lips, and I understand why. But from my perspective, I don't think this going to zero really changes the calculus for anybody. All right, scrolling here, seeing if there was any other questions. I trade Bitcoin, but I'm unprofitable. Can I switch to Forex? Yeah, of course. There are a lot of crypto traders who began trading FX. They traded foreign exchange. You can do that. You can absolutely do that. There's a lot of clean action in FX. And in fact, this year, FX has been a more attractive market to trade than crypto for most of 2023 because it's actually been trending a lot of the time. It's been moving in a direction. It hasn't just been chopping around eternally like Bitcoin and Ethereum and the others were doing for most of this year. But if you're going to move to FX, then you probably need to spend some time developing that toolkit a bit, understand which parts of the market are important for FX trading. You want to pay attention to the DXY. You want to have be more attuned to the economic calendar, particularly interest rate announcements from different central banks and things like that. Those directly affect the FX markets far more than crypto. And so if you're not accustomed to looking at those things, a seasoned FX trader will be. And that's just something to kind of keep in mind. If you're going to start trading the euro and the pound and things like that, then you need to start having an opinion about the DXY and keep an eye on it because King Dollar drives all those other pairs. And just those are the kind of things you have to think about if you want to move to FX. You can absolutely do that. Every market that has charts is tradable. You just kind of need to understand the nuances of it and which data points are important for that specific market. You made a suggestion that we could see lower lows. Would BTC act like gold during a recession? I suppose it could retrace if it's overextended, but new lows. So the entire idea that Bitcoin would set new lows has not been a TA forecast of mine based on any kind of like wave counts or fractals or anything like that. It's based purely on the historical fact that the stock market has broken down into new lows every time it's had a recession from whatever bounces it produced before then. And so with that logic in mind and with the knowledge that Bitcoin and equities have always had a relationship of some kind, then that leads me to the belief that if we have a real recession and equities break down below these levels, that Bitcoin is going to follow it in some way, right? It might not follow it immediately. Maybe it leads. I'm not really sure what that plays out. No one really knows. But in the initial move of the recession, Correlations go to 1. Everything moves in the same direction, and it becomes a liquidity grab. It's a cash grab, right? It's everyone flocking to the exits at the same time. And the most liquid assets in those environments are the ones that sell off the quickest, right? Those are the ones that people have the most access to. Gold is one of those things. Bitcoin is also one of those things. It's 24/7, 365, borderless, global, right? So I think that it has a high risk of setting new lows if we actually get the recession. Now, if we don't have a recession, if the economy actually threads the needle, well, then we have a lot to talk about. Everyone who shat down Jerome Powell's neck would have a mea culpa to deliver, because he would arguably be the greatest central banker in the history of the United States if, big if, gargantuan if, he actually threads the needle on slowing down the economy, beating inflation, and we never actually have a real uptick in unemployment, and we don't really have a recession. If that plays out, Bitcoin probably won't set new lows. The bottom is probably in, because as far as Bitcoin is concerned, it has completed its bear market, right? Its bear market drawdown. Relative to itself and everything that relates to Bitcoin and every on-chain metric that we could go look at, right? I've got my Glassnode dashboard over here. Let me reload this. Based on pretty much everything that Bitcoin has to say, its bottom has been put in. Let me find MVRV. Here's long-term holder MVRV. And this is just one metric, but this period of time we've gone down, we've kissed the lows, we're now climbing out. It looks kind of like 2015, right? But we're now on this big retrace. Maybe it looks like 2019. I don't really know. It doesn't have to look like either of those. But if we're just going to look at Bitcoin, Bitcoin looks like it bottomed. And as far as it's concerned, it has. So I think that the only way that it becomes different for crypto and Bitcoin is if it is not different for the economy. So that let me add some color here to this. I said this the other day on Twitter, and it was kind of me making like a joke paradox kind of tweet. Let me show it to you. Here it is, where I said, if indeed this time is not different for the economy and boomer markets, then it ironically means this time likely is different for BTC and crypto writ large. And what I mean by that is everything we've been talking about related to the recession, right? We had the yield curve invert. We've had the cyclical parts of the economy in major drawdown and showing the kind of growth rates that happen before recessions. We've got the Fed tightening because of high inflation. We had CPI over 5%. When you combine all that stuff that we talk about together, recessions happen with extremely high consistency. Like I can't put a number on it, but it's probably more than 90% because we only really have one example of it not happening. And there's over a dozen of it occurring. So it's over 90%. And that informs a lot about where you think TradFi can go. And so for you to think that this time is not different for, there's always that joke in markets, this time is different. And it's usually not, right? Most of the time, history has a way of repeating itself. Each era is unique, but the factors that drive downturns tend to be consistent recession after recession. So if we believe that this time is not different and that we probably will have a recession, if we do have one, then it will be different for Bitcoin because Bitcoin has never seen one. TradFi hasn't had one since before Satoshi published the white paper. So by saying this time is not different for the economy, that harkens back to something that hasn't happened since 2008 and before. But it's never happened for Bitcoin. So that's the weird position that we are in right now, is that we are anticipating a certain outcome for the boomer markets that is very consistent historically. It has a strong opinion about those things happening. Bitcoin has never seen one. Risk assets have a certain behavior profile in recessions, all recessions. There are no recessions randomly where everything just rips to the moon while, thousands, millions of people lose their jobs. There was one weird recession in 1945 where the market went up the whole time, but we also didn't have high unemployment like we normally do. The recession was mostly because all the war spending got taken off and we had a big drop in public GDP. But the private sector kind of held up during that period. It wasn't really the kind of recession that you normally would model. But every one of the other ones has seen risk assets go lower. And so that's where I'm coming from with Bitcoin. That's where I'm coming from when I say it is a high risk of setting new lows, is because, as I said, if this time is not different for the economy, then it is different for Bitcoin because of the period of time Bitcoin has existed in. It has conveniently existed during a window of time where there has been no real end to the financial cycle. It's just been a kick after kick after can kick for 15 fucking years. So that's where I come from with this. Bitcoin had its bear market cycle. It's now in the early bull phase. Clearly, you can see that in the price. If you look at it on chain, we can go through this metric. I could go through a dozen of them, and they all show a bottoming formation. If you look at the amount of time and the percentage of drawdown from the peak in November to the bottom of December last year, November 2021 to the bottom of November last year, even that period of time is within like a week of the other prior to bear markets for Bitcoin. It all closely relates. So BTC is going to move forward until something interrupts its normal cadence. And that thing would be a recession. So that's how I look at it. That's my perspective, and it's important for you to understand that if you're going to listen to my content and my analysis, is that's where I'm coming from. I don't have some secret information about Bitcoin that makes me think it's for sure not done with its bear market and that it must go lower. I'm informed by the economy. I'm informed by the fact that Bitcoin has closely been tied to tech stocks since its inception. It may have periods of time where it looks a little more like gold than other times, like in the last couple weeks. But largely, if you zoom out and you look at it on like a monthly chart, a quarterly chart, look at it over years, it follows tech stocks. It follows the Dow Jones as well. It follows equities more closely than it follows its own catalysts. In fact, if you look at Bitcoin and you look at, I'm not going to be able to chart it on here, but I can tell you I can tell you the data points, the statistics. If you chart Bitcoin, and you can do this yourself, and mark the all-time highs of each cycle, and then find the date at which Bitcoin finally breaks above that level later in the next cycle, when that period is. Then do the exact same exercise for the Dow Jones, and then note the dates of the Bitcoin halvings. If you do all of those things, what you will find is that the breakout for Bitcoin above its prior all-time high is an order of magnitude more closely related to the same breakout in the Dow Jones than it is to its halving events. So on average, this moment for Bitcoin, when it breaks above the prior all-time high, is about 200, I think it's 220, 240 days. And I'm going to look it up real quick. It's 200 something amount of days on average from the halving itself to the breakout, 200 exactly. From the halving to the breakout for Bitcoin. But the breakout for Bitcoin is on average only 61 days separated from the breakout on the Dow Jones. So 61 days versus 200 days. That's an multiple orders of that's an order of magnitude faster in a way. It's definitely about 70% faster. Maybe not an order of magnitude, but Bitcoin follows equities. It follows breakouts in traditional markets. It follows liquidity and risk appetite. And so if we have a recession, those things get hit. It doesn't matter how much stimulus you think that they are capable of pumping into the economy. That ignores the numerous recessions that we have had in the past in the presence of the money printer. The money printer is not a cure-all for recessions. They cannot avoid a downturn, a deleveraging, just because they have a money printer. All they can do is delay the inevitable, and they can slow those things down, or they can try to encourage growth and recovery after we have one of those events. But they can't just magically stop it from happening. So that's important to take away, and the close relationship of Bitcoin to traditional markets. So you marry all that together, and then you take a thesis that says a recession is still very possible and likely. Then it informs my expectation that BTC could set new lows. But that doesn't mean that you don't buy Bitcoin if you find it valuable. That doesn't mean that you don't have any exposure to it. I'm constantly trolled on Twitter by people who think that I'm sad and sidelined because I talk about recessions and because I have expressed the view that Bitcoin has a risk of setting new lows if we have one of those. That doesn't mean that I didn't buy. I bought throughout this period. I have not bought any Bitcoin in here, but I did buy here. I did a lot of buying down here because we were below the 200-week moving average. We were below the realized price, and because on-chain metrics across the board were screaming bottom. I had no idea what was going to happen. I had no idea FTX was going to happen. It fell below a price that I had been buying at when that occurred, and I bought some more. I hope that everyone did that. That's my long-term stack. That wasn't a trade. I didn't buy that on Bybit with a stop loss at 15.4 and I'm just like sitting on it. It's my long-term hodl stack. And I hope that everyone else did that, right? Like you don't want to think, oh, well, there's maybe a recession 6 or 9 months from now. I'm just going to completely avoid all markets. I mean, you can do that if you want, but you might get left behind, right? DCAing in a downtrend is an RIP strategy. Yeah, you're right. I had to do a lot of modifications during this. You know, like I was reducing my my DCAs for the first part of the year, but once we got below, I think it was about 25,000, middle 25s, wherever the realized price was at the time. In fact, let's just look at the realized price, guys. Let's look at it real quick. Realized price. Yeah. Right around here. Where was this? 24,000. This period of time, we got below it and we stayed below it. And somewhere right around in here, I slightly increased the amounts that I was buying. It's not a DCA that I do, but it's like a fairly regular buy that I manually do. You know, I like to do it myself. I don't like to just automatically have it going in the background. But it was around this period of time, and I was increasing it until I got to my allocation level, till I used the money that I had planned to use. But yeah, you don't want to be buying all the way down, like buying. That sucks, because then you end up with a cost basis right here in the middle somewhere, and you're still underwater. Now, I do have some UTXOs from like back here, but during early part of 2022, I wasn't buying a whole lot. I started buying in the summertime, and I increased it down here, and then I stopped. And I haven't really bought a lot in the high 20s and in the 30s. I used to have just like a daily DCA, like, you know, back during the bull market. I was doing like a little, but it was really small. It was a super small one. And I didn't like that. You know, I kind of stopped that somewhere in the middle of the year here. I was like, that's not the strategy to go with. And I just got rid of it. All right. We're at an hour and 5 minutes. Let me get through some of these questions. And then there was, I wanted to touch on the ETF thing at the end, if I could. Thanks for sharing an excellent analysis with us. Greatly appreciated. Who's my dude? Thank you, man. Who's Crypto, Hussein, he and I met at a Bitcoin conference last year in Miami, and he was really generous, really nice guy. That was really cool to meet him. And thank you, my friend. It was very generous. Thanks. Icky Matter, Itchy Matter. I talk to you sometimes on Twitter too. Thank you for the generous donation. Really appreciate it. Everyone gets a second job to cover expenses and then spends money on services. There are more people getting second jobs. That is true. We do see that data. It is a small number, though. It's important to remember. It is a very small number. Multiple job holders is about 8 million people. The number of multiple job holders, let me see, multiple job holders, primary and secondary, both full-time. It's less than 500,000 people, but it's at all-time highs. So that's concerning, right? That's the highest print we've ever had on working 2 full-time jobs. But if you're just a multiple job holder person, as a percent of the employed, it's only about 5%. You can see it's still a pretty low figure. But yeah, that is a dynamic that happens when you have high inflation. That's for sure. Big Shroom with the donation. Thank you for you and your content. Really appreciate that. Very generous. Thank you so much. All right. There's a couple things that I want to talk about. I want to end the stream on this. We've talked about the crypto market a bit. We talked about TradFi. We talked about recession odds. There's more that we can discuss, but we'll save it for next week. We're doing these weekly now, by the way. I want to go back to a tweet that I sent a couple days ago because it got a ton of feedback. And I just want to add some of my thoughts since this is my stream. So I tweeted this last weekend, and it absolutely blew up. 1,100 likes is a lot for me. I have a big Twitter account, but I actually don't get this many likes on most of my tweets. 200 is a lot for me. So 1,100 was crazy. It had over 500 replies between the main post and the next two. But what I wanted to share on this and what I was thinking about, there's a lot of excitement around the ETF. It might get approved sometime in the next few months. We might see one or multiple spot ETFs for Bitcoin from BlackRock, from Van Eck, from whoever else filed them, ARK, etc. And that's amazing. That's wonderful. It's another channel for people to get exposure to the price of Bitcoin using certain assets that they currently cannot allocate, or certain markets that can't allocate, right? Certain kinds of retirement accounts and things like that, certain types of institutions. They can't get exposure to Bitcoin in its current state. They need this kind of an instrument. But along with a lot of the kind of reasonable conversations around the ETF, there's also a lot of what I will call irrational exuberance around what the potential could be. There's a lot of people that believe that the ETF will create demand, that there is pent up demand that is trying to get at this asset and that it can't, and that as soon as the ETF is available, it's going to be like a floodgate. And maybe that's true. I have no idea. And in truth, neither do the people who say those things. They literally don't know. They're just guessing. They're hoping that that's true. And it's a cool story that gets a lot of engagement. But I'm someone who I want data to show me something to corroborate what people are saying, at least a behavior that we can take away. So I found this. And now Canada has had multiple spot Bitcoin ETFs since 2021, 2020. They have 3 or 4 of them, I believe. One of them is the Purpose Bitcoin ETF. They also have one by a company called 3IQ. And then there's a third one called the Bitcoin Fund. And those two are much smaller. If you go look at the absolute holdings, the assets under management, etc., they're smaller than the Purpose Bitcoin ETF. And Glassnode actually has the Purpose ETF listed. So I made this chart. And when I tweeted this, what I was thinking was, okay, so it looks like this ETF launched in maybe February or March of 2021. It launched at the top of the market. Let's just put that aside. Don't point that out to the bulls, right? They'll have me hanged. But the ETF literally launched at the top of the market. But anyways, We saw some inflows from the ETF, right, for a few months here, and then it dropped precipitously around the time that 3AC and Celsius collapsed in June of last year. And there was a Canadian fund that had, or was it Quebec? The province of Quebec, some element in Canada had exposure to Celsius in the tens of millions, and that might have been part of the reason why this exposure here was closed off at this period of time. But we saw some inflows during the bull market, and then they just ended abruptly during crypto winter, and they've been flat ever since. This is, June, July of last year, and ever since then, this is BTC, Bitcoin. The BTC holdings have been essentially flat. Now, they've ramped up a little bit here in the last couple of days because price broke out, and that makes sense. If price is going to break out, you would expect this to go up a little bit because people buy things when they're going up. It doesn't make sense, but that's what people do. But my question, and some people tried to answer it. Other people took me posing this question as a direct threat to their belief system and chose to insult me anyways. I just wanted to know, this is not a rhetorical question. I'm legitimately asking this. If there is an urgent desire by people to have access to Bitcoin, to have exposure to Bitcoin, if there is an urgency among people to do that, and we have the Canadian economy, which is not the US, and it's not nearly as financialized, which everyone keeps pointing out to me. However, it is a top 10 economy in the world by GDP, and it's literally our next door neighbor. And if since July of last year, there has been no hint of any kind of steady allocation behavior to this asset, then why do we think that this behavior will be fundamentally different in the United States? Like fundamentally just a completely different beast, not at all like this. I can't wrap my head around that. People keep telling me that, well, BlackRock has a bunch of money and America's a lot bigger of a country and we have more financialization. Okay. Those things are true, but they don't really address my core question. My core question is about the behavior of the human beings in Canada. I'm not asking why they don't have their own version of BlackRock. I'm not asking why the Canadian assets are not as big as the US assets. Those things are explainable. What I'm asking is, if people in Canada actually want to own Bitcoin because they want exposure to it, and the ETF is a great way for them to do that, why is this not slowly going up? It doesn't matter what these numbers are. It literally doesn't matter. They could be 5K, 100K, 1 million Bitcoin. It doesn't matter. Why is the line like this and not like this? That's my only question. And I asked that, and I was literally torn to shreds by like 100 different maxis. I was called an uneducated dumbass. People told me, it's Canada, bro. Like that explains anything. BlackRock has trillions under management. Again, missing my point. Why are the humans in Canada not choosing to put a portion of their retirement every month into this asset so that this number slowly climbs over time? That's all I'm asking. That's it. No one has really given me a great answer. I've gotten a couple of decent ones, though. Some people trying to present the idea that Canadians allocate their retirements a little differently. Maybe they put them into other kinds of assets. Maybe the fund managers and people who would give that kind of advice, maybe they're prioritized to sell different kinds of products. I don't know those things. I'm genuinely wanting to know. And so if you have any insight, you're welcome to share that with me. I'd like to know that. But a lot of people just missed my point. And this is really all I was asking is why is this not a gentle drift higher rather than a complete flat line for, 15 months? At least it's not sloping downwards. That's absolutely true, Alessandro. At least it's not going down. It just seems like it was forgotten about, right? Clearly, people were allocating. Somebody left, and then nothing happened. As prices going down and then going up, nothing happened. And it wasn't really until, over here, we broke out, we got up here, we saw it increase. We got up here, we're seeing it increase a little bit. And we can check back on this in like a month or so and see if it's increasing again. And maybe it is. Maybe it takes on this behavior again. And my question is answered. Oh, it was just, maybe they were just recovering from crypto winter. I don't know, guys. And this isn't me fudding the ETF, which is another characterization from people I actually know in person, people telling me that I'm just fudding the ETF because I'm uneducated. I know I'm uneducated. That's why I'm asking the fucking questions. How do I learn unless I ask? I'm not afraid to ask and to admit that I don't know something. But you can't tell me that this is going sideways because Canada doesn't have a BlackRock. Those things don't make sense to me. Why aren't the people slowly allocating over time? That's all I want to know. Secondly, last piece on the ETF. This tweet was going around. BlackRock's Bitcoin ETF might have trading support from heavyweights like Jane Street, Jump, and Virtue. These are liquidity providers. These are big desks in TradFi. And I had two thoughts when I saw this. This was a really popular tweet for Walter Bloomberg. 1,000 people liked it. 150 people retweeted it. A bunch of other people were sending out this CoinDesk article. But I had two thoughts when I read this. My first thought was, you literally just described all ETFs. All ETFs in the world have the trading support of heavyweights like Jane Street, Jump, and Virtue. So that's not even news. But then secondly, I was thinking, okay, this news article is trying to convince me, the reader, that the Bitcoin ETF will have some kind of exposure from these big desks that it doesn't have right now. And that because of that, they will have a demand function that we don't even know how to measure right now, right? They're gonna be hungry for this shit. They're gonna come in and they're gonna push price up. And then I started thinking, okay, well, there's this thing called CME, right? The Chicago Mercantile Exchange. That is where the Bitcoin future is currently listed. BTC1 on TradingView is the Bitcoin future on CME, right? This has existed since 2018. It started at the beginning of the last bull run, which is hilarious when you think about it. Look, here let me do it this way. Let me flip these around. Sorry, guys. I'm going to make the red line BTC1 so you can just see, I can make my point here. If we go back to the top of the last bull run right here, that is when the futures began, which is hilarious because also that is when the Canadian ETF started at the top of the bull run. But anyways, there's this thing called the Chicago Mercantile Exchange. They already have a Bitcoin instrument. And guess what? Jane Street and Jump Capital are liquidity providers for the CME. They're already on there, right there. These guys perform, below is a list of firms that have provided permission to be listed for clients interested in executing block trades. So these guys will help you facilitate a large position on the CME in their instruments. They currently have a Bitcoin instrument. So Jane Street and Jump Capital or whatever are already they already have access. They do right now. So this isn't news. That's my this isn't news. They described all ETFs, and then they listed two liquidity providers that are listed on the website of the only place in America right now where you can buy spot Bitcoin futures or whatever, not a futures ETF, but like buy Bitcoin futures instruments, like commodity futures. The only place in America where you can do that. So I don't bring this up to be a fudster. It's in my nature to investigate claims because I'm not smart enough to just already know the answers to things. I need to go find out. And when I went and looked into this, I just kind of found a bunch of smoke. And this felt like a total non-story to me. And this is exactly the kind of shit that I see from people about the ETF. And like when I go look at the replies, here, this guy replied to my thread. What am I missing, right? And this guy replied to me, ask this guy. And he told me to go look at this person, Nigentropic. Well, the funny thing is, I know this guy. He's one of the co-founders of Glassnode. I used to work there. So I actually know him. So it's kind of funny that I was told to go read this. But I was told because look at his post. The introduction of the Bitcoin spot ETF is reshaping the financial landscape. Demand is on the rise with $15 trillion in assets from companies seeking Bitcoin spot ETF approval. See, there's all these, I call it smoke and mirrors, but I feel like there's probably a better word for it. People think that just because these institutions are very large, that necessarily opens all of that capital up to come into Bitcoin. But some of these places can get exposure now. If you're a big player in America right now, you can get spot Bitcoin. You know, you can go on Coinbase. Michael Saylor did that. If you want to trade Bitcoin's price action, you can go on CME and trade it with big size. And in fact, the people that they're saying will help you for the ETF are already listed as liquidity providers for it. And whenever people are talking about what the ETF's going to do, like they just refer to assets under management, and it's always some number that starts with a T. It's always some trillions. And maybe that is true. And if it's true, then we'll find out real soon and everyone's bags will go to the moon. I'm just trying to apply a critical eye. I don't have an agenda here. I don't gain anything by presenting these ideas because I get criticized heavily for it, which doesn't bother me, but it's really like the main outcome of me even raising these things in the first place. But I just want you guys to think about this stuff also so that we can have a more rational conversation around what may happen if there is a spot ETF approval. Because I think a lot of it, a huge component will have to do with what the economy is doing, what the equity risk premium is, what yields are at when the ETF launches, and how much uncertainty there is for the economy in the months ahead at that point in time. All of that will play a role in what happens to Bitcoin when the ETF launches. So anyway, that's my rant about that. I wanted to share it with y'all so that you have more color behind my perspective. I don't just raise these things to be like a counter trend actor or a fudster or whatever. I legitimately want to know. And it's really easy for people to glom on to bull-tard narratives. And there are a lot of cheerleaders. Bitcoin Twitter doesn't need more left curve cheerleaders. It needs more people asking thoughtful questions. And I'm trying to bring some of that to the table. So, all right, that's about it. We're going to wrap up here. We got 200 viewers. We got almost 200 likes. That's amazing. Thank you so much. We're about 1-to-1 on that. I love to see that. Let's check back in on the markets real quick. Let's see how we're doing. Everything's still looking pretty good. DXY is down for the day. Yields are down on the long end. Equities are up another 1.5% after yesterday. The S&P is just absolutely ripping. Holy crap. In the last 3 trading days, it's up 3.2%. That's pretty good. That's pretty good for the S&P, particularly for how sharp this drawdown was. And recall, like we said, it came right on a perfect bounce of this level here, of this resistance now turned support. So maybe we carry higher. We'll have to see. Maybe these tailwinds that we discussed with the surprise less amount of duration coming to the market, with the expectation that the Fed might be done hiking, all of that is a potential tailwind. And the S&P could go, all the way up into these levels and not have set a higher high, and then it could just roll back over. So those things can happen. And, just remember, it's happened in this cycle already. We've gotten some big rallies only for it to roll back over. So I'm not reinventing the wheel here. Ryan with the $2 finally caught up. Thank you for all your input. I really appreciate that, Ryan. Just my thoughts. Okay. So we're going to wrap it up here. I really appreciate all you guys. If you haven't yet, make sure that you are subscribed to the channel. Let's go pull it up for you. Alpha Beta Soup. Make sure that you are subscribed to my channel. Make sure you hit the bell icon so that you are alerted when I go live. And we will do another live stream next Wednesday or Thursday. I'll send out a link 24 hours in advance like I have been doing, and we'll just keep on rolling. Economic data from now till next week is a little bit on the light side. So this chart and the related charts might not have a lot to update, but we still have other things we can talk about. And that is where we will leave it, friends. So until next time, take care of yourselves, take care of each other, ask thoughtful questions. When you hear something that sounds almost too good to be true and someone is trying to convince you that there are trillions of dollars about to flood into your favorite asset, think about how that could happen. Ask some questions and don't be afraid to be the guy who doesn't immediately believe the bullish thing you hear. It won't make that thing any less bullish. It'll just make you a little more thoughtful in your approach to the markets. So that's where I'm going to leave it today. I really appreciate all of you. Thank you so much. You are the reason why I do these streams. It's very rewarding for me to come on here and share my thoughts for y'all and to get feedback from you. So I thank you so much. And we'll talk again in about a week from now. Cheers, everyone.